A trading system built on Martingale logic operates exactly like a heavy weight suspended by a single thin tether. It holds steady under normal conditions, but apply enough continuous unidirectional pressure, and the underlying mathematics ensure the structure violently snaps. In a standard grid system, the algorithm responds to a losing position by aggressively averaging down. It opens progressively larger trades at predefined intervals, assuming the price will eventually reverse. The mathematical flaw appears when an underlying market trend continues to move against it without retracing. This creates a severe left-tail ruin scenario. Because the position sizes scale exponentially, the capital required to maintain the grid exhausts itself before the market ever reverts to the historical average. The account equity instantly collapses to zero. Because of this guaranteed failure mechanism, quantitative consensus holds a strict view on grid algorithms. They are toxic, unpredictable, and must be universally avoided. Unchecked mathematical expansion without structural boundaries is not an investment strategy. Over an infinite time horizon, it guarantees catastrophic account failure. Yet, this creates a mathematical paradox. While unbounded grids are doomed to zero, imposing rigorous, absolute boundaries on that exact same mechanism can yield a survivable system that generates consistent alpha. This brings us to the architecture of the JPY Dynamic POM Grid portfolio. This chart displays a multi-year stress test of that specific algorithm. Note the smooth, stable trajectory of the lowest light yellow curve. That line represents the fully optimized, tightly bounded system, outperforming the volatile, high-level configurations above it. To understand how this stability is achieved, we have to reverse engineer the architecture through a 10-phase quantitative discovery timeline, mapping exactly how the developers neutralized left-tail risk. Transitioning from a gambling mechanism to a rigorously engineered machine requires treating grid limits as absolute structural physics rather than optional suggestions. The first phase of discovery addressed the baseline flaw in standard grids, concentration risk. Most retail systems rely heavily on the US dollar, exposing the entire portfolio to a single point of macroeconomic failure. The Phase 2 solution was the construction of a triangular JPY loop. By linking USD JPY, URR JPY, and GBP JPY through essential URR GBP crosspair, the portfolio creates an organic market hedge. An aggressive runaway trend in one specific currency pair is mathematically counterbalanced by the opposing reactions of the crosspairs, effectively dampening overall portfolio volatility before it can trigger a margin event. But choosing the Japanese yen as the base currency wasn't arbitrary. Phase 7 relied on a specific quantitative tool known as the Hurst exponent. Hurst exponent testing mathematically calculates whether a time series is trending or mean reverting. The tests proved that JPY pairs exhibit strong structural mean reversion, validating them as the optimal baseline asset for a grid strategy. We can see this in the empirical trade data. The log files confirm the algorithm is actively and dynamically cycling between these specific pairs to manage risk holding times across the loop. By replacing single-direction wagers with a cross-currency structural hedge, the architecture mathematically neutralizes the concentration risk that destroys standard grids. Structural hedging solves the asset problem, but Phase 3 required mapping intraday liquidity environments to identify safe operational hours. This chart tracks global FX market spreads over a standard 24-hour cycle. Notice the massive, sharp spike occurring explicitly between 2200 and midnight. This is the broker rollover window, representing a daily liquidity vacuum. Phase 4 implements a hard logic rollover filter. By systematically locking the algorithm out of the market during this exact window, the system cuts out the sharp, unnecessary drawdowns caused by artificially widened spreads. Beyond daily predictable spikes, algorithms must survive unpredictable macroeconomic shifts, moments when global volatility suddenly disrupts normal market behavior. Phase 8 counters this with a dynamic volatility dampener. This logic block monitors real-time market turbulence and actively restricts grid expansions when extreme events trigger. This ensures the algorithm stops attempting to average down when the macroeconomic baseline breaks and the market ceases to mean revert. These combined time and volatility constraints transform the grid from a blind reactive loop into a context-aware system that simply refuses to engage during toxic market regimes. Even with hedges and filters in place, the core question remained: what is the absolute physical limit of the grid itself? Phase 5 answered this through the max global level stress test. Look back at the multi-year stress test chart. The topmost purple line tracks a model allowed to expand to a massive 32 levels. Observe the erratic, deep vertical plunges in its equity curve. The data lays out a brutal trade-off. The 32-level configuration yields an impressive 499.8% return, but the cost is an absolutely fatal 83.3% drawdown. It survives the simulation, but no human trader could stomach the volatility. Phase 6 required locating the peak Kalmar spot, the exact mathematical configuration that perfectly optimizes the ratio between return and risk. The math isolates exactly 8 levels as the superior constraint. By capping the grid there, the system captures a 122.7% return, while choking the maximum drawdown to a highly serviceable 15.3%. Phase 9 verified this logic by measuring basket recovery stats, tracking exactly how quickly individual trades successfully escape the grid. Parsing the CSV trade logs proves the strict boundary holds up in reality. The bulk of the volume sits at levels 1, 2, and 3. The system extracts its profits early and rarely needs to push toward the 8-level ceiling. Unlimited greed destroys the portfolio. Mathematically capping the grid isolates the mean reversion alpha while surgically amputating the left tail ruin. Building an optimal system on past data is easy. Phase 10 required proving this 8-level, hedged architecture wasn't simply overfit to historical anomalies. The validation method relies on Monte Carlo simulations, taking the historical logic and running the architecture across 10,000 distinct randomized market paths. This out-of-sample walk-forward testing confirms the algorithm survives completely unseen randomized market sequences without breaking the 8-level constraint. These tests prove the mathematical boundaries hold up under severe sequence risk, completely independent of isolated, perfectly timed backtests. Monte Carlo validation graduates the system from a theoretical hypothesis to a statistically verified trading architecture. The completed JPY dynamic palm grid operates on 3 uncompromising pillars: the cross-currency loop, context-aware temporal filtering, and the strict 8-level global cap. The long-held professional consensus remains correct in one distinct way. Attempting to trade an infinite grid is mathematical suicide, but the failure lies in the lack of boundaries, not the mechanism itself. It is only the unbounded grid that collapses under the weight of Martingale math. By rigorously engineering these mathematical constraints, the strategy effectively manages left tail risk, neutralizing the primary threat that drains algorithmic accounts. When structural hedging is forced to operate within absolute mathematical boundaries, a system can safely extract reliable alpha from the market's natural mean reversion without succumbing to catastrophic ruin.